one thing that I remember quite well. You know, there were top management trainers, well-paid people who train these corporate top-level people that are very busy and have no time for training. And you think about what do they still need to learn. And of course you think, I need to explain them how the capital market values their firm and so forth. Now the training that I remember quite well when I read with was made specifically for Japanese managers. And the training was as follows. Here was a busy road with many lanes. And here are the offices. And you put the CEO right here. And you put some other guy right here. And then you ask the CEO, please shout as loud as you can so that he can understand. This is a real world training. You pay a fortune of money for this training, and this is what you learn. Because if you are a CEO, everybody needs to understand you. And if you are from Asia in particular, you are reluctant to speak up loudly. So you have to overcome your inner reluctance and resistance, and you have to learn how to do this. When you are in a karaoke bar, all of you can sing very loud. And you are extremely relaxed and good. But if you are in a classroom, of course you are very shy and you don't want to speak as loud. But you have to learn to speak at least as loud as I do. Whenever you have the impression the professor is speaking stronger, louder than I do, then remember this exercise. You don't want your company to pay $10,000 just for you to do this exercise. You can train it yourself. So I really recommend to you, try this out. Go on 2 different sides of the street and test out who can basically say a business-related sentence so loud that he will be understood on the other side of the street. And if you pass that street and that test, then you are one step closer to become a successful manager. Okay, but now, and of course this has to do with not only with voice, it also has to do with basically your personality. If you are a CEO, you must be outgoing. You can't be shy. And so this training, of course, is only one test out of many things. But basically, they try in this training to change the personality to become really a CEO kind of personality. Okay, so now let's go back to where we ended last Friday. Corporate trader, he can increase the firm value to XR. R stands for radar, and this was bigger than XI, and I stands for income. So under the control of the current managers, the company is worth little. Think about Continental. It's undervalued. Profitability is below the peer firms. Now the radar comes and say, I can do it better. And he offers XR, which is nice. It's bigger than XI. But the shareholders basically think, my own decision, I'm a small shareholder, and all the others are also only small shareholders. And like in a political election, my vote will not change the outcome. So basically, I can neglect this event. I'm just too small to be important. I can just think, if there is a success or if there is a failure, what is the outcome for me? If there was a failure, if the firm is not taken over, then I would end with XI, the current share price anyway. But if the firm is taken over, I either get B, the offer price, or I get the higher share price, because after taking over control, this company will become worth more and more profitable. And of course, then we said, then it's and as long as B is smaller than XR, as long as the rater can still make a profit on this, the shareholders, who are of course here well informed, they have exactly the same information, they all agree on this. These shareholders will say, I prefer XR to B, so I rather decide to retain my share. And the result is, if this model is true, then rating is very difficult and actually not profitable. Because a trader has to pay some transaction costs, pay his consultant and his investment banker, and he has to pay full price. So all the profit basically goes to the shareholders, nothing is left for the trader. And then basically the people that saw this theory basically said, now I understand why the bidding firms usually have no price increase in the share price. When a bidding firm takes over an acquired firm, usually the share price of the acquired firm goes up tremendously, and the bidding firm shareholders do not gain or lose a lot. So there seems to be empirical support. And then people said, but if the bidding firm, if the bidder, or if the trader cannot make profit, we have to change the law such that he can make some money. And that's where we ended. So basically we said, maybe we have to give him some private benefits. Maybe we allow him to steal some corporate assets. Of course, that's in the first place not good for the shareholders. But it may be necessary to convince the trader. And we had this. And another extreme form is the leverage buyout. This is basically one American invention, how to make things very profitable for the trader, and we want to understand this.
So
the idea is, yes?
Last time when you mentioned about the cash deal, is it the same with the leverage buyout? Or like last time when you mentioned in the
I mentioned LBOs already, So but to be very honest, an LBO is not a precisely defined thing. This is an extreme form of an LBO that is presented here, and the leverage buyouts in practice. But first of all, corporate law in Germany and in the United States is quite different. So here what you learn is basically simplified. It's the same thing, a leverage buyout, but a very simplified model that it used to be possible in America. And you see, a leverage buyout, first of all, a buyout is just a corporate acquisition. A buyout usually means you buy something like 100% of a corporation. And an LBO is you use much debt, because leverage is just another word for it. And of course, from country to country, the amount of debt differs, and 100% is of course the ideal, but many LBOs basically say 75% is enough. And if it's 100%, then this is often the going private. So many people basically say a buyout is nothing else than another word for going private. Because if you have 100%, why should you still list it on the stock exchange? There is no stock price if there is only one owner and no more trading of the stock. But be aware, many buyouts basically have only 75%, have the stock price remaining. But this here is really an extreme form, over 100% takeover, and only here in this textbook. Textbooks usually study the most extreme forms. And the proposal here is you want control. So here basically you tender for 50% in the textbook. And instead of using your own cash, you pay with 100% debt. This is our textbook example. So only meaning 100% debt. And the difference is this will become the debt of the target corporation. What Americans basically invented is a trick, and the law allows the corporator to attach the loans directly to the corporation. So this is a very simplified kind of thing. Initially, of course, the trader goes to a bank and says, I need the money, please give me the money, and then the trader becomes the debtor. But then during the LBO process, the debt actually is handed over to the corporation. So in the end, the corporation needs to be the debtor. So the corporation basically pays with the debt for its own takeover. And so at the end, the corporator owns 50% of the shares, but the corporation basically is responsible for repaying the loan. And this is really a highly simplified description of the much more complex details that go on. And of course, if everything is paid by debt, then the waiter doesn't pay anything. And this is not precisely what's going on, but here one deal in 1982 gives a reading. The investors use only 1 million in own money. And then they bought 79 million, so that was almost 100%. They bought the company, and then just 18 months later they sold the company for 290. So the profit is roughly 200 million. So you invest 1 million and receive 200 million just 1.5 years later. So this is one out of many examples where LBOs created enormously large profits for the raiders. So the Grossman-Hart idea, the corporate raider receives nothing, was clearly not true in that case. And of course the fact that the corporation takes over the debt, that enables them to receive this huge amount of debt, because the bank knew that if the transaction is completed, the company will need to pay. And then basically this makes this possible. And again, the details are much more complicated. And of course, only the textbook basically can assume 100% debt finance. In the real world, you don't have this. But we want to apply this principle and to see why this Grossman-Hart free rider problem is not the case, how much money we can make. So, very simple thing, $40 share price, 200 million shares are outstanding. So the market cap, basically that company has 800 million in assets, because $40 times 20 million shares. And that can be increased by another 400. This is the delta. It would be increased by 50% if the waiter takes over. And if you assume that the share price, that the acquisition is purely financed with debt, let us calculate what is the maximum amount of value you can, basically the waiter can expect and still complete the deal. So please take some time to think over it. Any ideas how much? How you would, if you are asked to consult the waiter, and the waiter asks you how much money can I make from this transaction, then let's calculate it through. Let's do assumptions and calculate something. So, what do you propose for the bid price? say, let's just try something. You want to make profit, so you don't offer a premium, and basically then hope to make the biggest profit. Yeah? So you calculate, suppose you are able to buy these shares at the current market price. Yeah, that sounds like the biggest profit. Maybe, of course, you have to offer a premium. And you bid for 10 million shares. Yeah, so you need debt of 400 million, obviously. That's the amount of money that you have to put on the table. This comes all from the bank. And if you can basically transfer this to the company, then the company will later on have still equity, and it will have 400 million in debt. It will have 2,200 in assets, because by assumption it increases by 50%. And then basically the equity will be 10 million shares owned by bidder, 10 million by other shareholders, and they are worth 10 million. What is the share price now in the new one? The share price is, of course, assets minus debt is the value of equity, so 800 divided by the number of shares. 800 divided by 20 million shares. The new share price will be the old share price, $40. And this is the value of the firm minus the value of the debt divided by the number of shares, which is constant, and is 20 million. Recognize that this $40 and this $40 just by accident is coincident. Because this 40 is the value of a not taken over firm that has no debt. And this here is the value of a taken over firm with increased assets, increased by 50%, but with also debt. And here in this example, the share price will be unaffected. So, the bidder after the LBO owns 10 million times 400 million dollars. And he starts from zero. So in this simplified example, he made 400 million. And then the question is, will the old shareholders accept this offer? They start with the share worth 40, they end with the share price worth 40. So at least they have no reason to reject. Maybe they say, I also want a little bit from this. This is clearly the maximum. Either way, suppose.
Professor, can I ask?
Yes.
So the bidder borrow 100% of 400 million and owns 400 million. So do they have to pay the debt and then forgive?
If it's true what this slide says, sorry, no, one slide before. The law allows the corporator to attach the loans directly to the corporation. Initially, it has his own loan, and then basically he makes the corporation take over the loan. And the mechanism is a bit complicated, so you basically have a first have an acquisition company that is only used in order to acquire the company. That acquisition company has all the loans, and then you merge the acquisition company with the target company. And the end result, which is really so that these debts here become this is the balance sheet of the target corporation, and this will, in the end, have the debt. And it is surprising, what is the mechanism? That this debt is then the target corporation's debt, but it works in the US. It doesn't work precisely like this, it's 100%, and the mechanism beside this is a bit more complicated. But if you ask ChatGPT about the details of the construction, then usually you will read that there is a kind of acquisition corporation. This does nothing else than basically we have an acquisition corporation. It has nothing else than 400 million in cash and 400 million in debt. And then you merge this with the target corporation. So basically it's an add, and then this comes out. So initially the acquirer basically builds this acquisition corporation. It has no equity at all in this space. In reality it has a little bit of equity. But you saw this example, only 1 million, and it's 79 in debt. So it really works. And so there was tremendous profits for the raider if he can really if he can use this kind of mechanism. And the interesting thing is just think back on this. Here, the shareholder basically say, the bidder, shall I accept the offer, or shall I simply hold to my shares? I want to stay a shareholder. In this example, you get an offer of 40. So B is 40. And if you retain, you get the share price after the company is taken over, but the share price after the company is taken over is also 40. So there was no profit from not tendering. There was no reason to increase B to more than 40 because this is not higher. So basically, even if you offer a 0 premium, just 40, there is no reason to keep onto your shares, simply because after the transaction, you will not see this value increase. The value of the company is of course increased from 800 to 1,200, but the share price is not increased. And therefore, you don't have this reason anymore to wait and stay. So you are at least indifferent, and by assumption then you sell. In economics, we assume if you don't mind, then you whatever. And you can actually there were other examples. Suppose it's complex enough for you. But you may try to increase or decrease the share price, and then of course you will get different new share prices out of it. And sometimes the people, although the offer is really bad, but if after the takeover the outcome is even worse, then people are forced basically to accept a bad offer, simply because the raider will basically destroy. The raider is here effectively stealing 50% of the company. He's not paying anything, he's getting 50%. That doesn't look fair at all. And if you say this is possible, then everybody wants to become a raider. But of course, it's not that easy to do this. You still need a bank to trust you, and you don't need 0 equity, but a little bit. But this is a counterexample that shows that the Bosman Hart model, this is the model that we have here, may not be correct. That the opposite may actually should have a profit rating is extraordinary really profitable. Yeah, and if you look at the equity stake in LBO transactions, they were really below 10% in '87. Yeah? But then they increased simply because maybe there were some legal changes that basically made it more difficult to do this kind of transaction. Also 0% equity is of course only the theoretical extreme case from the textbook, but there were corporate traders that used extremely small amounts of equity, and then of course became quite rich in these years. Yeah, so this 80 years takeover wave, which is already 40 years ago already, yeah, there were lots of companies taken private through LBOs. It's already gone, yeah, so taken private means 100% was really taken over. Yeah, quite often the incumbent management was a big part of this. Yeah, they became big shareholders through these transactions. If they are strong big shareholders, they have very strong incentives. Yeah, basically, they have their personal wealth invested into the firm, and of course, they place much more emphasis on shareholder value. They usually have also a lot of debt. The managers, yeah. If you think you have enormous amounts of debt, but also all your equity invested in the firm, of course, you work very hard to drive up the share price and. And of course, the high leverage also imposes discipline. If you are in that situation here with lots of amount of debt, you have to pay out the interest. If the profit is not sufficient to pay out the interest payment, your company is bankrupt. And the manager is also bankrupt. So the debt is another kind of, we would call it incentive device. The debt is forcing you to be disciplined, to work hard, and And also you have these leveraged buyout funds, which are professional private equity managers, and they sit on the boards and basically say, I want my money back. And then these firms quite often achieved a tremendous improvement in profitability. And the common explanation is that is the result of completely changed incentive structures of managers that work much harder, that focus much more on the share price and on profitability, simply because they have all reasons for this, or they are forced by debt and by the LBO partners who basically force them to do so. And that partly is, it was not only in the 80s. I think all the big takeovers in the recent 10 years were all LBOs. So the big wave of LBOs actually started after 2000, and is still going on. It's not that extreme. This extreme example is without any equity. Of course, today you have banks that are more conservative and that require traders to invest in equity, but still, this effect prevails. The debt that you use just in order to acquire the firm. And you have an acquisition corporation that does nothing else than taking on the debt, and then it has this 500 million in cash. And of course, then this cash goes away, and you basically buy the shares of the target company. And then you merge these two companies, and then these shares and this equity basically is consolidated, and you have the assets of the firm and the debt still on the balance sheet. So this is how LBOs work. In the end of the process, the debt is really sits on the balance sheet of the firm, and is not the debt of the acquirer. And that's amazing and robust. But it's not 100% debt. The 80s wave was basically over in 1988. It was just when I was finishing my university, my master degree, and the reason was simply legal changes. The financing was no longer available. There were legal changes in the US. Basically, there was so much in the newspaper. People got so incredibly rich. Corporations complained so much about the threat of being taken over that the laws were changed and the party was over. But what is not here on is after 2000. Yeah? And I think the wave was much bigger than before. And today we have the LBO market basically dominating the M&A business. A large part of company takeovers today are in the form of leveraged buyouts, usually by private equity funds, and usually with lots of debt. Yeah. Then what can also exist is squeeze out means the shareholders are not asked. Yeah? Here basically we say I offer something and I hope that 50% of the shareholders accept this kind of offer. Yeah? But what if you basically can force the shareholders out? Yeah? In the very beginning I had Dell Corporation, the computer producer. He obtained 50% of the votes with this offer, and once he had control, he was able to force all the others out. Yeah? So, Mr. Dell basically said, look, I pay V to the first 50%, and once I have control, the others don't get XR. They are basically frozen out, yeah, they are forced out of the company, and then just pay him a very small amount of money. Yeah, if this is legally possible, yeah, then of course nobody can hope for this high value, and the model is again poor. Yeah, and nothing forces you to offer a high V and attractive bid price. Yeah, so one example of a free merger is the Audi. Basically, just read this. Volkswagen is the majority owner of Audi. Audi had also some small minority shareholders, and they were simply, they were offered this cash compensation for their shares, and basically they didn't have a say. They had to sell this for this amount of money, and this is called a squeeze out. It's a special form of a freeze out. So M&A bankers must also be good lawyers and understand under what circumstances can you basically force the people to sell. And in this case, this was possible. And of course, if you force people, you must pay an adequate price. Whatever this is, and this 1,500 was found to be the adequate price. Yeah? And from that day on, you had only Volkswagen own 100% of Audi, and no longer any other shareholders.
Can I ask,
Yes.
Freeze out merger is really different from leverage buyouts, or it's like different story?
Freeze out is simply the fact to force out other shareholders. If you think that you have a large corporation with thousands of shareholders, because it's basically impossible to buy 100%. No? But if you want to delist from the stock market, you need 100%. So every law basically says, like American law in particular, if you have 50%, then there is a legal mechanism that allows you to basically to go to 100%. Okay? And then all the remaining shareholders are forced to sell. Yeah? Freeze out really means you force the other shareholders out of the company. Yeah? And of course you have to offer them a fair price, yeah? Or a fair consideration. Yeah? Sometimes you pay with shares, yeah? But of course, and then the law basically dictates what you have to offer. Yeah? But there are legal mechanisms to get rid of shareholders that you no longer want in your company. Yeah? And this is needed if you really want to delist. Yeah? Going private means you really want to be the complete owner of the company. Yeah? You don't want to be listed on the stock market. You don't want to argue with minority shareholders. Yeah? You want to be the only dictator of the firm, and then do whatever you want. Yeah? People say this is complete control. Yeah? If you have 50% control, that gives you a lot of power, but not complete power. And minority shareholders still have some rights, and can basically prevent you from doing some things. And in a going private transaction, we basically squeeze out or freeze out the other shareholders. Yeah? So it's usually a second part in an LBO. Yeah? In a typical LBO, you first buy 50%, and after you obtain the 50%, you basically force out the other people. and pays the price. Yeah, and if you're allowed, you saw the example of Dell at the very beginning. Yeah? Dell shareholders sued and said the price that we got. So basically Dell basically said, either you take B or you are squeezed out. And let's say B was 10, and then you only get 9. Then of course you have a pressure to 10. This is better than that. So even if the share price currently is 40, if you say either I get 10 or I get 9. So this corporate trader will kill me anyway, but selling right now is even better. And then there was a freeze out. And then basically the court said, but this was too little. You must pay more to the shareholders. But whatever you have to pay, it is the result of a valuation. And these valuations are made by investment bankers, are made by very influential people. Don't expect that small minority shareholders are treated fairly in these kinds of things. We have legal protection, of course, and in particular in the United States, there's legal protection for minority shareholders. But as you saw in the case of Dell, sometimes you are treated badly. And only if you have a nice board, they basically prevent the worst. But Mr. Dell clearly became a very rich man from this takeover, and the shareholders wanted, at least they complained. So suppose you are in that situation here, you have a share worth 40, and you are threatened with a takeover where basically, which is not at all, which is going to be destroyed. Or at least it is so unfair that only the raider makes a lot of money, but the shareholders do not. And what you do, you could try defense. And the first defense is, of course, just say no. I like in the Time Warner merger, the Time shareholders, no, it wasn't the shareholders. If the management says, I don't want this, they can prevent many things. And then what sometimes happens is a proxy contest, which is a counter reaction of the acquirer. If the management board says, I don't want to support this, I am against the proposal by the raider, and the raider wants to take me over, and I resist, then the raider may basically try to convince the shareholders to unseat, that means to fire the board members and hire new board members instead. He basically goes to the shareholder meeting and says, the target board manager is selfish and only wants to rescue his own job. I make the proposal to fire him, and then afterwards I will make a nice takeover. And this is just one out of many examples. So Xerox is here the bidder. They were bidding for HP, Hewlett Packard, and they basically nominated candidates to replace all of the 12 members of the Hewlett Packard board. The Hewlett Packard, the target company, did not want to be taken over. They basically said no, and would have killed the deal with this. But then the counter reaction of the bidder was let's propose to the shareholders to replace this. And it gives you a nice idea on if you're a manager. You can of course say no, I don't do this, but then the risk is of course that you will be fired in a proxy contest. This particular proxy contest was not successful, but they were lucky. This was in 2020, and when COVID reached the markets, Xerox basically said we are no longer interested. So the voting by the shareholders never took place. The acquisition was abandoned because of the COVID problem. But defenses, besides just saying no, I resist, and maybe then we're replaced. A poison pill is a very prominent anti-takeover provision in the United States. clearly state that this is not possible in Europe, simply because in Europe we have a different corporate law, and the law basically requires an equal treatment of all shareholders. And you will see this is an extreme example of an unfair or unequal treatment. So the rights offering, well, the poison pill is a rights offering. Yeah, the rights offering is just another word for a capital increase. There are more shares. Yeah, rights is just another name for shares. There are new shares produced, and the target shareholders have the right to buy shares at a deeply discounted price. So a typical pill is if bidder buys more than 10%, then every other, only the other shareholders, get one share for free. And suppose the share price is really 0. Yeah? So they can buy new shares. And here it is 1-to-1. Yeah? For every old share, you get one new share. Yeah? And the deeply discounted price in this example is simply 0. Yeah? Suppose this poison pill is basically in the corporate charter. Yeah? So it is existing. And we think about what is the effect. Yeah? So we start again with this, 800 we had. Yeah? We have 200 million shares, each worth 800 outstanding. Yeah? And now a bidder comes and basically buys 10% of the shares, yeah? Maybe at the current market price at 40, and the poison pill is triggered. What is the effect on the shareholders, and what is the effect on the bidder? Well, there are 20 million shares outstanding before the pill. How many shares are outstanding after triggering the pill?
14.
Not yet, because the bidder does not receive the new share. Only the other shareholders. And every other shareholder gets one share. Yeah? It is an instrument such that the bidder will be penalized. Yeah? So the other shareholder, that is 90%. And they receive a new share. So basically this
38.
Yeah. 2 million is owned by bidder. Yeah? And then these 80 million will turn into 36 million shares. Yeah? So we have in the end 38 million shares. We still have the same value. Can somebody calculate the new share price? Okay. So basically, the bidder invests 2 million times 800. That is 1.6. That was a million, 1.6. That's 800 million, yeah, 1.6. 10% of the shares, 2 million shares, times 2 million times what? That's 80. 80 million. Yeah? Yeah? He buys 2 million shares, each worth 40, yeah? So he pays 80 million. Yeah? And after, he has 2 million shares times 21. Yeah? So the loss is roughly 39 million. And the poison pill simply means, if you attack our company, try to take it over, you will incur a loss of 39 million. Which is not really big. It's just 5% of the overall firm. So basically, the poison pill looks like an extremely toxic poison. It looks like if everybody else gets a share for free, and the pill not, on first hand it sounds like, well, I will never trigger the pill, because it seems so unfair to me. It's such a big advantage for all the others, they receive one share for free. But of course, also the other shareholders, they used to have a share, one share worth 40, afterwards they have two shares worth 21. That's only 42. So the benefit for the remaining shareholders is not that big. It's not that they double their income simply because they have two shares instead of one. You have to really calculate that through and see basically this pill basically forces the bidder to pay 39 million to the other shareholders. Because this is what he loses, and the loss of the bidder is of course equal to the benefit of the other shareholders. They can guarantee a profit from roughly 5% of the firm value with this poison pill. So
I think like it's legal, right? So
yes.
I think that it's so unfair because like you can target a group of shareholders and make them have more share and also like more money.
It's legal only in the United States. In Europe, we have a principle of equal treatment. So you must treat all shareholders equal. You can say all shareholders have the right, they get a new share, but you can't say only the bidder receives no shares and all the other shareholders get one extra share. That's of course an unequal treatment of the different shareholders, and that's forbidden in Europe, but in the United States, the United States and the capital market law are extremely liberal. They allow almost everything. And basically say both the bidder, if you think about this LBO example, it looks like the bidder can easily make enormous amounts of money just by taking over the company and then basically using only debt and then imposing the debt on the company. This is unfair for the bidder, the LBO. This is unfair and an advantage for the shareholders. And the Americans actually believe if everybody has access to all kinds of weapons, this is a defense weapon, and this LBO kind of thing that we just had before. This corporation here, where we calculated that the bidder can easily make lots of money from this. Basically, the Americans believe created equilibrium, where basically both the bidder and the shareholders have access to strong weapons. And in Germany, the standard defense is not allowed, all over Europe.
So like, it is like, I mean like, so we can completely defend by raising the ratios, like we can dilute like so much that the bidder gain nothing at all at the end.
I think these are the two important things. Is it really for free? And did you get only one share? Or maybe you get 100 shares every year? Then of course you can basically destroy it. If you say everybody gets 100 shares for each old share, then basically all of his investment is basically gone. After trading the pill. And there were legal limits. Basically all this is in a takeover situation, you really have to ask your lawyers what is possible. Not absolutely everything is possible. The pill that I described is commonplace. Many corporations have this. Even more drastic pills, but you don't have unlimited freedom. So many corporations, you may just ask how many S&P 500 corporations have a poison pill, and ChatGPT hopefully will be able to answer, I think more than 50%. Not all, but a very large proportion. And is it attractive? Well, if you think you are a shareholder of that corporation, do you love having the pill or don't you? You may say, this gives me a nice share price increase. Yeah, so if there is a bidder, I get more shares and I profit from this. But of course, on the other hand, it will be less likely that a bidder comes. Yeah, the bidder, of course, sees the poison pill and says, oh, this is unattractive for me. Yeah, so in the end, there are pros and cons of poison pills. Yeah, and there was evidence, yeah, when corporations had no poison pill before and now start to introduce one. Is it good or bad news for the stock price? Is the stock price increasing or decreasing? And interestingly enough, it's quite often increasing. Yeah, so people initially thought, yeah, a bidder that bids a nice price is quite often above the share price. Every shareholder loves to be the target of an acquisition. Loves bidders to come to make nice offers, because the bids are offering a premium. And a poison pill, yeah, looks like frustrating bidders, yeah, and reducing the probability of a takeover. Yeah. But in fact, these companies that have poison pills are quite often nonetheless taken over. And if they are taken over, yeah, the financial outcome for the shareholders is better. Yeah, so it is not clear whether this is in the interest or not in the interest of shareholders. Yeah. What other kinds of, yeah, this is a landmark case where I think the pill was invented for the first point of time. Yeah. Staggered board or classified boards. Yeah, this is when people have a 3-year term, yeah, so they're elected into office for 3 years, and if you have 1/3 of them elected every year, yeah, then it takes you 3 years to replace all the directors. Yeah, you can easily replace directors when their term is over, yeah, and when they have to be replaced anyway, yeah, like in democratic elections. And this is an easy trick how to prevent, yeah, that a bidder quickly takes over control. And you see these staggered boards very popular. Almost 40% of the companies have staggered board. Poison pill, yeah, it used to be 60% 20 years ago. Poison pills have declined a lot, yeah, simply because nowadays other defense weapons have become more popular. Yeah, so both instruments are widely used or have been widely used in the past. And of course, some people argue this is too much defense. Yeah, there were too few takeovers. Yeah, takeovers are good for society. They increase shareholder value. Yeah, and we should not have defense. Yeah, these are only managers who try to defend their own positions that do this. Yeah, but actually, there are also opponents who say this is good in order to force bidders to pay an attractive price. And empirically, the evidence is quite mixed, yeah, whether this is something positive or negative. But of course, if you think Germans basically forbid this, poison pill is not allowed in Germany, Americans allow this. Of course, there was a lively debate, yeah, whether it makes sense to allow this. And most Americans, of course, tend to believe, yeah, that what they have in America is good. So they basically say poison pills are needed, yeah, in order to have a well-functioning capital markets. And in Europe, we actually believe that this is not the best way to proceed. Yeah. Another defense is a white knight. So you have a bidder who is offering B, and then you hope that a good friend is offering an even higher price. Yeah, a friendlier company, and basically Time Warner is the perfect example. Yeah. Time doesn't want to be taken over by Paramount. Yeah, so the white knight would be then, please Warner, take us over. Yeah, because Time Warner was a merger, and Time was the dominating party. Yeah, but suppose that you understand you will be taken over, you're just too small to survive on your own. Yeah, and then the manager says, better be taken over by a good friend, and then by the evil private equity company or by the corporate raider who will fire me. Yeah, and then a white knight defense is basically looking for something. And that is investment bankers' job. Yeah, when investment bankers look at precedent transactions, of course they also screen the market. who is in the market to buy companies like the tire business or the automotive business of Continental. Who could we contact and ask? And who could we ask basically to do it more friendly? The rater is hostile simply if he basically says, I don't ask the management for support, even if they say no, I try to buy this firm. And of course, usually the management team will be fired afterwards. So a white knight is somebody who said, could you imagine buying that firm, paying a more attractive price than the corporate rater, and of course still to continue to work with the company board, or at least find a friendly agreement, such that they will not object this. And it happens quite often. White knight defenses, there is some research on how often it happens, and then of course also whether it's in the interest of the shareholders. Then a golden parachute is something very, very nice. The golden parachute is nothing else than a large amount of money that is paid to the chief executive officer or to the board members if the manager, if the firm is taken over and the managers are let to go, basically fired. So if the company is taken over, basically the management say, you don't have only to buy the shares, you also have to pay my golden parachute. I'm now a rich man because the golden parachute entitles me for a large payment. By the way, in the United States, golden parachutes are quite often hundreds of millions of dollars, and they really flow to individual people. In Germany, again, this is very restricted. I think the golden parachute is no more than 3 or 5 times annual salary. So maybe something between $2 and $10 million. It's an extra payment that the bidder has to do. And of course, it looks like this is increasing the price and therefore makes takeovers less likely. But on the other hand, of course, it makes the manager of the target firm much less resistant. If the manager basically fights against being taken over, think about what time, the time company. All shareholders of Time want the Warner takeover to be accepted. They want $175 million. But they only receive this if the Time manager says, okay, I agree, Time will be taken over by Paramount and I will be wiped out. If he would have had a golden parachute, then he said, okay, I lose my job, but I get maybe $50 million, and that's enough to compensate me, and then he would allow this takeover to take place. So a golden parachute is also a means of overcoming managerial resistance, and if managers are so powerful that they basically can block the takeover, as we saw in the Time example. The manager is basically not acting in the interest of the shareholders, not in the interest of the owners of the company. He's simply protecting his own empire, his own job, and then of course a golden parachute can help. And again, there were many golden parachutes adapted. So this is something that the shareholders must approve. So the CEO basically goes to the shareholder meeting and says, dear shareholders, would you please vote yes for a golden parachute that gives me, the chief executive officer, $50 million if I'm being wiped out and fired as a result of a hostile takeover. And surprisingly, many shareholders basically say yes, this is what we want. And the share price reaction to this is quite often positive. You think this is something that pleases only the chief executive officer, but indeed the empirical evidence says it makes sense. In Germany again, there were strong limitations. In Germany there was one important case, and you saw in the beginning the Mannesmann takeover was the biggest takeover ever in the world, and the chief executive officer of Mannesmann, of course, was fighting fiercely against being taken over. He didn't want to be fired. When Vodafone took over Mannesmann, he basically had to go. And he did not have a golden parachute, yeah, but he and some other people obtained 60 million as a kind of, basically the contract was, please resign, yeah, make this takeover possible, and just take the 60 million. This was the outcome, yeah, so it was basically a spontaneous golden parachute that was provided in the negotiation, yeah, simply because the people, all the shareholders sitting on the table said, we want this takeover to happen. Yeah. The chief executive officer is basically fiercely rejecting. We have to break his resistance, yes, so they will just pay 60 million. Yeah. The German courts basically said this is unlawful. Yeah. This is stealing shareholders' money. Yeah. You can't simply take cash out of the corporation and pay it to a chief executive officer if he did nothing else than resign in return for it. Yeah. This is strictly forbidden. Right? You can pay large salaries, but it must be always a salary for some effort, for some real work. 60 million just for signing your resignation letter is not allowed. So this was an exception. From that day on, it is clear in Germany that this will not happen another time. But it's a good example that you sometimes need to pay huge amounts of money in order to let the shareholder wishes come true. Yeah? The shareholders profited a lot from this takeover. Yeah? All management shareholders wanted to be taken over. Yeah? And very much like in the Time case, yeah, the CEO simply rejected. Yeah? Also the Time shareholders, yeah, should have gone to the CEO and said, yeah, please let Paramount acquire you. Yeah? What is your price? Yeah? Is it 60 million or something? Yeah? And although we think that 60 million is a lot of money, but we pay it, yeah, just to get you out of the room. Yeah, and no surprise, of course, that this this 60 million payment, yeah, has produced hundreds of articles in the press, and similar things in the United States. So the very fact that investment banking and M&A is so prominent is, of course, that you read all these kinds of news articles about this, that in M&A, yeah, the director already all of a sudden becomes a millionaire, yeah, just because of these kinds of payments. And yes, and then of course everybody knows that M&A is about big amounts of money. Yeah, next defense, a recap changes the capital structure. So let's think about this example. So here again we have the acquisition corporation. Yeah, it gets 400 million in cash and 400 million in debt, just because this will later end as debt here. Yeah? The banks that provide this debt do this only, yeah, because after the transaction, yeah, this is relatively safe. Yeah? This is only 33% of the overall balance sheet once this has become 1,200. Yeah? But suppose the company already has a lot of debt. Yeah? Suppose, yeah, that as a result of the takeover threat, you basically say, I have no debt yet, yeah, but I basically buy back. Maybe I buy back 50 million and simply remain with 5 million shares and have a huge amount of debt instead. Yeah? So you exchange debt for equity. Yeah? Then of course these people here would say, no, this company already has a lot of debt, yeah? We can't put more debt on the company. Yeah? And then basically the leverage buyout becomes impossible to administer. Yeah? So recapitalization, yeah, just buying back shares, reducing the amount of outstanding shares and replacing them with debt is an easy way to make it impossible, yeah, to take this company over in an LBO. Yeah, and this is basically what we do. Yeah? Also something. Yeah. Choose, issue debt, and then repurchase stock. This is the traditional thing. Yeah? There are other firms, well-known, other takeover defenses that we cover only quickly. A supermajority. maybe 80% to approve a merger instead of 50%. Actually, this is not the most difficult thing. If you look at Facebook, at Google, and many others, they have multiple voting rights. Yeah, quite often 10 times. That means you have class A shares, with 2 classes of shares, class A shares and class B, and class A has 10 votes and class B has only 1 vote. All the shareholders get these class B shares, and the founding owners, Mark Zuckerberg for example, he gets these class A shares, and then with maybe he has only 5% of the shares, but this allows him to control 50% of all the votes, because he has so many more voting rights. And that is often done in the US with these tech firms. Mark Zuckerberg and Sergey Brin and his friend who basically founded Google, they basically have only a small fraction of the Google shares, but they have the majority of the votes. Those multiple voting rights. Once they should sell the shares in the market, they will automatically become class B shares. So they can't give this extra voting right to their son as a successor. It's only for himself, so it's not forever. You can of course restrict the voting rights of very large shareholders. Basically, some corporations basically say you can't exercise more than 20% of the votes. And some minimum price amendments also happen. So defense is many firms try everything in order to prevent being taken over, or at least to raise the price. And the time case is of course a nice example. Okay, let's have a break right now, and then after the break we continue with the